3 discounted stocks to buy now. We're going to analyze their historical performance. We're going to jump into their dividend safety of each company, looking at their financial metrics, understanding why these are deeply discounted, that we need to add what we love about the company, as well as jumping into their stock valuation model, looking at their intrinsic value and finding our acceptable buy price given our investor margin of safety. So let's jump straight into the first stock. It is Cisco Systems. It is a multinational digital communications technology corporation. And for those that don't know, they did in fact report their earnings just yesterday, where they did have a beat on both their top line as well as their earnings per share. However, they have lowered their guidance. Hence, we can see it is down around 11.3% in the pre-market, which puts it right there at its 52-week low. Now, it does offer a yield of around 3%, as we can see here, and investors who have been holding the company over the last 10 years would be up a very nice 143%. Remember, that doesn't include their dividends reinvested. So when we take a look at some of their financial information, let's start off dividend safety score, 91, very safe. Market cap, 216 billion, so it is a mega cap company. Now moving on to some metrics that we like to take the look of. Now let's start off with some key metrics around the recession for those that do see a recession looming. Well, last recession they didn't pay a dividend, so there is no comparative data. They had negative 14% recession sales, but bear in mind this was the average growth of companies in the S&P 500 during the 07-09 period. And we can see their recession return was roughly in line with the S&P, coming in at negative 59 versus the S&P's 55%. Now, when we scroll down to their dividend growth, we can see they did have a slightly poor increase this year of 2.6%. Remember, we always advocate on the channel around 4% as a minimum, as that was the US inflation rate over the last 40 years. Last 5 years, decent. It is keeping up with inflation. And the last 10 years, we do see 10%, which is positive to see every time we see double-digit increases. Now, they have been paying increasing dividends for the last 12 years, for those that do like to know that information. And in terms of dividend yield theory, well, it states the company is undervalued when the current yield sits above the 5-year average. So we have our first sign here of around reasonable valuation. And we can see the forward PE sitting roughly in line with the 5-year average, again showing some reasonable valuation. But remember, as always, we never look at any of these in isolation and draw our conclusions towards the end. We also see the PE 13.2, much lower than the sector PE at 22.9, so this is a sign of undervaluation. And now, given their price drop in the pre-market, we do see it towards that 52-week low. But as always, do remember 52-week low is not a signal for undervaluation. Likewise, 52-week high is not a signal for overvaluation. Now moving on to the payout ratios, and remember, for those that are new, we tend to focus on the free cash flow payouts. The earnings is susceptible to manipulation by management through accounting, so we tend to focus on the free cash flow. And remember, below 60% is our preference. It does give us that faith that management can offer those double-digit increases every single year that we love to see. And over the last 10 years for Cisco Systems, very, very positive to see. In fact, it has been below 50%, with 2023 coming in at 33% and 2024 expected at around 38%. So we should be expecting at the beginning of next year some nice dividend increase. Likewise, earnings data always available to investors, but we do draw your attention to the free cash flow per share. $2.11 in 2014, $4.65 in 2023. They have more than doubled that free cash flow over the last 10 years. And it is positive to note that those increases do tend to be consistent year on year, and it is moving in the right direction. Now, sales growth, remember what we do typically look for on the channel is between 3 to 7% as a minimum. And with Cisco Systems, it has been fairly inconsistent. We do see some years hitting that 4 to 7%, although we also likely see some negative percentages. Now, numerically speaking, how does that convey? 47 billion of sales in 2014, 57 billion in 2023. So they are at least keeping up with inflation over the long period. Shares outstanding, we love it as investors when companies do share buybacks, returning excess cash to our pockets. And Cisco Systems do in fact do that consistently year on year. 5.28 billion in 2014, 4.11 in 2023. So they have bought back quite a significant amount of shares over the last 10 years. Now remember, ROIC, return on invested capital, it is one of our 7 golden dividend metrics here. We like to see 10% or more because it gives us faith that management are able to effectively allocate their capital. It has been well above 10% over the last 10 years. In fact, the last 5 years it has been in the mid to high 20s, which is very positive to see, giving us faith in management. Operating margin, free cash flow margin above the minimums we like to see it at 12% and 5%. The operating margin, remember, the higher the operating margin, the higher that bottom line net income margin should be, which translates into more space for the company to offer those nice dividend increases. Now, one of the best metrics of this company is that net debt to EBITDA. Now, this typically shows us the number of years it would take the company to pay off all of their debt net of cash on hand. The last 10 years, this has been 0, which means if they wanted to, they could pay off all of their debt on the same day, showing that they do have quite a nice strong balance sheet with their total cash far outweighing their total debt. So that is Cisco Systems. So let's jump straight into the valuation. And as always, if you do enjoy the content, value is being provided, do hit that like button, do subscribe and hit the bell to be continually notified of these videos. And if you want to grab a copy of the valuation model to get to your intrinsic value or acceptable buy price of companies in your own portfolio, do click on that pinned comment below. Now, typically with reviews on the channel, we do run through every single model in quite detail: Graham's valuation, multiples valuation, dividend discount, the discounted cash flow to get to our intrinsic value. But today's episode will jump straight to the output. And as you can see, the intrinsic value is just the average of the models that we do run through on every channel. So this gives us an intrinsic value of Cisco Systems at $57.77. Now, with the current price down in the pre-market around $47.50, what we typically tend to do is start off with a margin of safety at 10%. Now, this is if it meets the 3 criteria: wide moat, strong financial metrics, and good forward-looking data. Now, remember, this really comes down to the investor's preference and their style, their risk strategy. So at 10%, it would be a buy up to $51.99. Now, if we were to go to 15%, now what this would show is that it is a buy up to $49. And if we were to expand it to 20%, it would be a buy up until $46. So right now, you could argue Cisco Systems, based on our estimates and judgments, is giving you a margin of safety between 15 to 20%. Now, what do Wall Street say? Well, they believe the price to rise even higher than our intrinsic value at around $59.59. So they believe you are getting around a 20% margin of safety and that the price will go much higher than what it is currently. But remember, as always, do your own due diligence and never copy what Wall Street say. Now let's jump straight to our second stock, which is AbbVie. Now, this is a pharmaceutical company and is one of the largest biomedical companies in the world. Now, year to date, it is down 15%. It hasn't had a great performance this year, significantly underperforming the S&P 500. It is right there towards the 52-week low and does offer a nice starting yield of 44.51%. Now, over the last 10 years, this stock, as we can see, is up around 181%, which is positive to see. It did hit its peak towards the beginning of 2022 at around $175. So let's jump into the metrics. Now, dividend safety score 70, it is safe. Market cap of $243 billion, so it is a mega cap company. Now, looking at some key recessionary metrics, what we can see with the comparative data that we do have in the recession, they did in fact have plus 10% recession sales, which was above the average growth rate, remember, of companies, as that was negative to a very high degree. Now, dividend growth, they did increase their dividend this year in October at 4.7%, slightly higher than that inflationary target that we always say and advocate to investors. And over the last 5 years, we see a very nice 17% increase year on year, which is very positive to see. Now, one thing to note with AbbVie, it was formed in 2013 when Abbott Labs did spin off their branded biopharma business. And what we can see is that they have maintained their dividend growth streak. So they are a dividend king, paying increases of dividends of 50 years or more. Now, in terms of dividend yield theory, as we can see, that yield of 4.51%, roughly in line with the last 5 years. So you could argue reasonable valuation. We do see the forward PE, though, slightly higher than the 5-year average at 12.4 versus 9.3. And we see the sector P at 12.4, lower than that of the healthcares at 16.3. Now, as I did mention, it is right there towards the 52-week low. Now, taking a look at the free cash flow payout, remember that is what we focus on. Below 60% is our personal preference. And what we can see over the last 10 years, other than 2014 where it got exceedingly high, we do see it below that 60% target. 2021, 2022 in the low 40s, with 2023 expected to be around the mid 50s. Now, when we take a look at their free cash flow per share, $3.63 in 2013, $13.70 in 2022. Very nice to see the consistent increases year on year. And do note we are expecting it to be around $11 to $12 though in 2023. Now, when we move on to sales growth, just as a reminder, 3 to 7%, we can see some very nice growth over the period. Some years performing much better than the others, and some years in the low digits, which isn't what we ideally like to see. But then when we do take a look numerically speaking, 18.8 billion in 2013, 58 billion in 2022. So very positive to see that top line has increased by roughly 3 times over the last 10 years. Jumping into the shares outstanding, remember, when companies do issue shares, it does dilute your position as a shareholder, and that is what we have seen for AbbVie around 2019 to 2021. So we can see over the last 10 years, they have increased that share count by around 180 million. So something just to be aware of with this company. ROIC, as always, 10% or more. You could argue for biotech companies, you are looking for a higher rate. And we can see on average it has been around that 25% across the last 10 years, with 2021 at 22%, 2022 at 27%, which is still very positive to see as an investor or potential investor. Margins. Now, we do expect higher margins from biotech companies. Operating margin 25% or more. Very nice to see consistently above that, with 2022 at 40%. Very strong. So that bottom line should in theory be much higher. And then we can see the free cash flow margin 20% or more, with the last 6 to 7 years being incredibly high, around the high 30s, low 40s. Now, finally, the net debt to EBITDA. Remember, we are looking for below 1.5 for biotech companies. This target does move depending on the industry of the company. So what we can see overall, whilst it hasn't been below that 1.5 consistently, in 2022 it is around 1.77, 2023 expected to be 1.86, so it might be something you do keep an eye on, as the lower the better in terms of that all-important dividend safety. So now let's jump into the valuation of AbbVie, and we will just jump straight into the output. But if you do watch other videos, we do run through each model, so if you haven't already, do take a look at these episodes just to understand how we get to each figure. So our intrinsic value is coming to around $172.60. Remember, it did hit its peak at around the mid 170s not too long ago. Current price has been suppressed. It is around $137.60. Now let's start off with our margin of safety of 10%. Now it is a buy up to $155, moving it on to 15%. And remember, these margin of safeties does come down to the individual investor's preference. It looks like to be a buy around our 15% margin of safety. Now, when we increase that to a 20% margin of safety, what we can see is it's still a buy, and therefore shows that around 20% margin of safety based on the estimates and judgments is what you are getting right now for AbbVie. Now, in terms of Wall Street, what do they say? Well, they believe the share price have a lot of room to grow as well, and they believe over the next 12 months it should hit around $170, not far off that intrinsic value we have calculated for AbbVie. Moving on to our third stock, we have General Mills. Now, this is a multinational manufacturer and a marketer of branded processed consumer foods sold through retail stores, and they have a huge portfolio of branded products such as Nature Valley, Haagen-Dazs and Betty Crocker. Now, we can see these share prices right there towards the 52-week low. It has also been hammered down 22% year to date, and does offer a yield of 3.65%. Now, investors who have been holding the company over the last 10 years would have seen around a 30% return on their investment, and we can see the share price did hit its peak at around $90 this year. Now, taking a look at some financial and dividend metrics, we see a very safe dividend score of 90, market cap around 37 billion, so it is a large cap company. And looking towards those recessionary metrics, we can see they did in fact increase their dividend during the 07-09 recession. Sales were relatively flat, but that was, remember, above the average growth. And we do see a not bad recession return of negative 12%, which beat the S&P's negative 5%. So this is actually a very positive company return, what I would say as a recession-proof company. Other companies that have minimal returns in negative during the 07 period, companies such as McDonald's as well. Now, dividend growth, very nice to see that 9.3% increase in June this year. A bit more disappointing to see the average over the last 5 years at 2%, but we do see a more positive 7% on average over the last 20 years. Now, they have been only paying increases for over the last 3 years. The reason for this, it was relatively flat for quite a substantial period, but do note they have been paying dividends for the last 125 years without a reduction, which is phenomenal. Now, dividend yield theory, remember, It does state that a company is undervalued when that current yield sits above the 5-year average, so we have our first sign of undervaluation. Likewise, the forward PE below the 5-year average, another sign of undervaluation. Remember, the sector PE at 18.8 above the General Mills is also another sign of undervaluation, and this is purely for information purposes. It is towards that 52-week low. Now, moving on to the metrics, what we can see in terms of their free cash flow payout, below 60% is what we target, and it has been below that for the majority. We do see 2023, it has come up slightly higher at 61%. But look, 2023 is expected to be around 51%, which is positive to see and does give us faith that we should be seeing a very nice, whether a single digit or low double digit increase next year. Moving on to the free cash flow per share, what we see here, $2.99 in 2014, $3.51 in 2023. It hasn't been the most fast-growing free cash flow per share company that we've analysed, but we can see it is consistently increasing over the last 10 years, with 2024 expected to be significantly higher at around $4.66. Now, when we take a look at the sales growth, ideally 3 to 7%. And it did go through a rough period from 2014 to 2018. But since then, the last 5 years, it has been around that 3 to 7%. Numerically speaking, what we see around 18 billion in 2014, 20 billion in 2023. So over the last 10 years, it hasn't had the greatest growth period, but ideally it has had an inflation increase on average over that period. They also do share buybacks, 646 million in 2014, 601 million in 2023, but we do also see a period from 2018 to around 2020 where they did do share issuances diluting your position, but over the longer period we do see share buybacks with around 45 million shares being bought back. Now, ROIC above that 12% we look for consistently year on year. The last few years in the mid-teens as well, so that is positive, gives us faith in management. And the margins for a consumer staples industry is fairly positive. We do analyze a lot of companies on this channel where they have a consumer staples and they aren't reaching that 16% as well as that 7% target we look for on both the operating and free cash flow margin. So that is always positive to see as well as the consistency. Now, net debt to EBITDA, that does impact that dividend safety. We do see a very nice safe score for General Mills. Below 4 is what we target for the consumer staples. And over the last few years, it has in fact even been below 3, with 2023 at 2.8 and 2024 expected 2.73. So that is very positive, gives us faith that that dividend will continue to be paid. Now, jumping into the valuation model. And as always, if you do enjoy the content, value is being provided. Smash that like button, hit the subscribe and bell button to be continually notified of these episodes as they drop. And remember, if you do want to grab a copy of the intrinsic value calculator to run companies of your own through in your portfolio, do click on that pinned comment below and pick up a copy. So General Mills, we're getting an intrinsic value of $74 and the current price is around $64.79. So starting off with our margin of safety of 10%, it would be a buy up to $66.27. Expanding that margin of safety to around 15%, we do see it would be a buy at around $60 to $63. So right now with General Mills, you are getting between a 10 to 15% margin of safety. Now, Wall Street, what they believe the price to go up to around $72 over the next 12 months. So they also believe there to be some upside to the current price, roughly in line with that intrinsic value that we have calculated. Now, for those of you that have stayed on up to this point, we are going to go through a bonus fourth stock to buy now, which is discounted, and that is PepsiCo. Now, as we can see here, PepsiCo, it is down 7% year to date. And for those that don't know, it is a multinational food, snack and beverage corporation that sells far more than just Pepsi. It is trading towards the mid to lower end of the 52-week range and does offer a yield just over 3%. Now, investors who have been holding this company over the last 10 years would be up around 94%, and we did see it hit its peak over the last 10 years just this year at around $196, $97. Now, looking at some metrics, we do see the dividend safety at 93, making it very safe. Market cap $233 billion, so it is a mega cap company. Now, looking at some recessionary metrics, they increased the dividend during the 07-09 period. Roughly, recession sales were flat, and we do see a negative 35% performance versus that of the negative 55%. Now, dividend growth, I'd love to see this double-digit increase this year, 10%. 7%, very nice to see over the last 5 years. And over the last 20 years, 11% is very nice. Always like to see double-digit increases, especially when it goes as far back as 20 years. Now, they are a dividend king, as they have been paying increasing dividends for the last 50 years or more. And in terms of dividend yield theory, well, what we can see is there is a sign of undervaluation as the yield is sitting above that 5-year average. Likewise, another sign that forward PE sitting below the 5-year average of 24. And we can see the Pepsi PE at 21, slightly higher than that of the consumer staples at 18.8. And remember, it is sitting right there towards its 52-week low. Now, in terms of some metrics, well, let's take a look at the free cash flow per share. And this is one that I would say just to keep an eye on. While we look for below 70% for consumer staples, over the last few years, the free cash flow has been higher, with 2022 at 111%. Now, what this just signals, just to make you understand, it essentially means that the company are paying out more in dividends than they're generating in free cash flow. But it is positive to see that they expect 2023 to come down to around 75%. Now, free cash flow per share, 447 in 2013, 406 in 2022. Now, it hasn't had the greatest increases over the last 10 years. It has been fairly consistent, but we do expect 2023 to be around $6 or more. So it is positive to see that they are starting to grow that over recent times. Now, sales growth, remember, 3 to 7%. Over the last 10 years, it has been fairly inconsistent, but from around 2019, over the last 4 years, it has been between that 4 to 7%, with 2021 coming in at double digits. Now, total sales over the last 10 years, it has gone from around 66 billion to 86 billion, which is still positive to note. It has been increasing, even though that with inflation and consumers releasing or starting to spend a bit less or choosing different products, they have still managed to increase their top line. Shares outstanding, 1.56 billion to 1.39 billion, so they do share buybacks, essentially returning excess cash to investor pockets. And when we look at that ROIC figure, very nice to see above that minimum 10%, and in fact, at the high teens or at the low 20s, so always positive to see that. Does give us faith in management. Margins, very nice to see the operating margin around that 16%. Remember, I did say earlier that consumer staples, while we do look for above 16%, it is one of those areas that they do tend to struggle with. So it's positive to see that Pepsi is around that figure consistently. And free cash flow margin around that 7% or more, again, positive to see. Finally, net debt to EBITDA, no real worries there for PepsiCo, below 4%, and it has in fact over the last 10 years been below 3%. 2022 at 2.22, 2023 at below 2, expected around 1.8. So that does give us faith in that all-important dividend safety. Now, finally, we jump into the valuation for PepsiCo. And remember, the intrinsic value is just the average of the models that we do run through for each individual company. And do go check out other reviews we have on the channel where we run through in depth every single company. Now, the current price is around $167. Margin of safety, let's start off with 10%. And again, this is purely just down to investment preference. You would be a buy if you believe 10% is sufficient or relevant for PepsiCo up to $172. Those looking for a larger margin of safety at 15%, it would be a buy at around $163. So you are getting between a 10 to 15% margin of safety right now on Pepsi. Now, what do Wall Street say? Well, they believe the share price to have some nice room to grow at around $189, roughly in line with our intrinsic value calculator. As always, if you do want to grab a copy of the valuation model to get companies of your own intrinsic value and acceptable buy price in your portfolio, do click on that pinned comment below. Or if you want to run through any of the models we have just run through today, you can do that as well. Finally, don't forget to smash that like button if you've enjoyed today's content. If you want to see more videos like this, hit that subscribe bell button. Drop your comments below. I'm interested to know, have you been picking up any of these below? Or if not, let me know why. What's your bullish or bearish case on each of these companies? And if you do want to look at any of these companies in detail, we have reviewed them on the channel, so do go check out the other videos. And let me know your thoughts on these type of videos. Do you prefer these videos where we do look at some discounted companies as a whole rather than individually? As always, have a great day. Smash that like button. It really helps the channel grow and for these videos to get pushed out to other likely investors. And don't forget to subscribe and hit the bell button so you do get notified when these videos drop on a regular basis. And finally, just don't forget to have a great day. Catch you on the next episode and take care.